At a time when investors are confronted with market volatility and a variety of challenges fueled by the uncertainty of inflation, unsettled geopolitical tensions, and economic pressures, Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. This is InvestTalk, independent thinking, shared success. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. This is a special Best of Caller Questions InvestTalk compilation program. Remember, the InvestTalk phone lines never close. Please call with questions. 888-99-CHART, 888-99-CHART. They will be played and answered on an upcoming InvestTalk podcast.
We're going to go talk to Paul in San Francisco, listening to us on KDOW. Hi, Paul.
Here I am again. I have a question about the 401ks. Now, there's one of the talking heads on KDOW. He bum raps the 401k. He says bad because there are hidden fees, he says. He says there's 27 of them. Can I get some confirmation of do they exist or not?
Yes, there's fees in the 401k plan that are kind of hidden. Most of them have them. They usually have the mutual funds in the 401k plan are usually have not the best funds and funds that tend to be higher in their annual management costs in those funds. And, there's fees because of the different reporting requirements required by 401k. So, yeah, there's we can call them hidden because they're not really transparent, but they are there. You can see them, but you just have to work to find them. So, yes, he's right. Okay?
Well, how about I can find them? I'll try to.
Good luck. Good luck, Paul. Thank you for the call.
Let's go ahead and play another voice bank question from a listener in Seattle. It came in earlier on 888-99-CHART.
Hey, Steve or Justin. This is Craig from Seattle. Got a question I'm hoping you can help me with. I'm building a shop on my property. It's going to be about $150,000, and I don't do debt, so I'm going to cash flow it. I should be able to cash flow about $100,000 of it just out of income and existing resources. The other 50 is going to need to come from some investments, and that was planned the whole time. My question is, I've got RSUs with a Fortune 100 company that'll be about $55,000, and then I've also got about a $300,000 brokerage account. My thought is to cash out the RSUs because I've got another 110 unvested, and that continues to grow year after year. They vest over 5 years and pay out quarterly. And because it's already part of my AGI, when they vest, I don't want to add to my AGI and pop into the next tax bracket. But I wonder if I'm missing anything, if it's better to take from the brokerage. Am I better off doing, because they're at a loss this year also, am I better off doing early shares that may have some gain or later shares that are definitely going to have some loss? Really just looking for your insight and to see if my thinking's right on the RSUs or if I'm missing something. Thanks so much. I love the podcast. Bye-bye.
All right, great question. And typically selling out of your RSUs is a good diversification strategy because most people, of their net worth, the RSUs become a large portion of their net worth. And it sounds like you're still working for the company, so will continue to vest over time. So your stake is naturally going to vest and increase over time. So that's typically a good place to go. Now, taking money from your brokerage account, there's no tax consequences there. Whereas the RSU, there are some tax consequences. So you want to really talk to your CPA about that tax consequences. Obviously, I don't have that information and what tax bracket you're in, and I'm also not a CPA either. But that's a conversation you want to have with your tax professional first, and then you can go and make that sale. Now, if you do, you probably want to also get long-term capital gains if you can. Any loss will be limited to how much you can write off each year. There's $3,000 per year that you can write off. But that's a question more for your CPA, knowing your full tax situation, how that will impact you this year as well as long term. But when it comes to, is this a good idea to think about selling your RSUs to fund your project? Yes, I do think that's good, because it'll probably help diversify your overall assets. So thanks for the call.
You can call right now and be part of the program. Let's hear about what your talking point is. 888-99-CHART, 888-992-4278, and you can get through right now.
Why do listener questions make InvestTalk better?
Which of these would you recommend?
Because each caller presents fresh questions in their voice.
I was curious if you still think aluminum has a ways to go from here.
When do I know the right time to take profits?
Should I be looking for an exit? Should I be holding here?
And listeners instinctively realize that InvestTalk uniquely offers a welcome dose of investing satisfaction.
I think you have a terrific show, and I've learned a whole lot.
Hey guys, love your show. I've been listening for several years now, and I've learned a lot.
Justin Klein and Steve Peasley understand what investors need and want.
I would look at it from a tax perspective. If there's no tax implications, move on, find better ways to use that money.
I'm going with the odds. I think a half position now would at least get you in it and get you watching it so you won't lose track of it.
Don't forget to call InvestTalk, 888-99-CHART.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
Hello, Steve and Justin. This is Eddie from Montana. First of all, thank you for all you guys do. Really appreciate the work that you put in. My question would be, in my 401k, since I have limited investment options, looking at the slight turmoil the market in right now, between small, mid, and large cap funds, how would you allocate your fixed percentage of money? You know, my risk being slightly higher since I'm younger. I don't mind some higher risk. Appreciate all the help, guys. Thank you.
Well, the highest risk, of course, is the small, then medium and large. But in this market conditions we're in, I think the better move will come, and more safe move will become from the large cap. So I probably, if you're young and you want risk, maybe 50% in the large cap and split it between 25 and 25 small and mid. You don't have very good choices in your 401k most of the time. You just can't. I'd rather see you have a value position as opposed to growth position. So, but you probably don't have those choices. You're limited. But, the reason why I say value versus growth, when the environment changed from low or lowering interest rates to now raising interest rates, growth stocks don't fare as well in a rising interest rate environment. So, not that they won't work, it's just they work less well and sometimes poorly because of the cost of money. Remember, these high growth stocks usually don't make money. They burn money. They got to borrow it. They got to produce it. They got to get it from somewhere. So it makes it tougher for them.
Now let's grab a live call next from Dan in Georgia.
Hey, Justin, how are you doing?
Doing great, Dan. How are you?
Doing well. Listen, what we did was I'm in a variable, and it was investing into the S&P 500 index.
Okay.
What we did was we pivoted from that, and they put me in 3 other funds, and one of those funds that they pivoted to was the Mainstay VP McKay High Yield Corporate Bond. And what are your thoughts on that?
First off, you're in a variable annuity, sounds like, correct?
Correct. I'm stuck in this thing for another 5 years.
Okay, yeah. Sometimes, remember, those annuities, the surrender charges usually dwindle each year. So it might make sense as you get closer to, it's usually 1% a year. It's usually a 10-year time frame. And each year that surrender charge drops 1%. Is that how this works?
I think so, yes.
Okay. So I would think about it, especially if you get a good buying opportunity in the market to cash that out at before you wait for the full 5 years, because it might make sense, to just bite the bullet, take a 2, 3, 4% hit. So that's number one, is try to strategically figure out how to get out of that sooner rather than later. Now the mainstay McKay high yield bond ETF is a very average high yield bond fund. It yields about 5%. Its effective duration is 3.6, so it's not long-term in maturity, so that's probably the best thing I can say about it. Its expense ratio is very, very high, so I would that's why you don't want to be in a variable annuity. A lot of people don't understand that there's fees within the annuity, and then there's high fees typically within those mutual funds that you get to invest in. So that's why they're terrible investment vehicles. This is an okay, probably slightly below average high yield bond ETF. Fine right now. It depends on what else the options are. But this is just kind of average. Thanks for the call.
The InvestTalk voice bank never closes.
I have a question for you about Amazon.
So your questions keep coming.
Question about PE ratios.
And that's okay, because Steve Peasley and Justin Klein specialize in unbiased guidance.
If I'm looking at a dividend company, I'm looking for consistency of earnings and dividends.
Your standard daily chart typically goes back 1 year.
Steve and Justin are fearless, so don't forget to call InvestTalk. 888-99-CHART.
Hi, Steve and Justin. This is Rick from Colorado. I was wondering how you set your target price to sell. Let's say you buy something at the bottom of its 5-year PE range. Do you extrapolate that out to the top of its 5-year PE range to sell, or do you pick something in the middle? Looking forward to hearing the answer on the show. Thanks.
If we use that as a trigger, just a simple PE, we would use a trigger of we'd probably use the Fibonacci numbers, maybe 60% rise from the top to the bottom of a range that the stock sells in. But yeah, it wouldn't be a 50% rise. We'd have to see a bit more than that of the range, the PE range. But we don't generally use the PE as a reason to get out. That's because the PE it changes all the time. The E changes, okay? The price changes. Everything changes. And what if we see an opportunity here that, they have some, for instance, let's talk about the most recent, what was that? The act that the Congress just passed. They say it's Inflation Reduction Act, which is not. You can't spend $800 billion and say that it's going to reduce inflation, no matter how you say it. But let's talk about that. They're spending a huge amount of money in the clean energy sector. So, I may not, if the PEs go up, I may let it run if I'm in one of those types of stocks that's going to benefit from all the money the government's spending on that over the next 10 years. So, you may not, that's why we don't just use the PE as a range, as a trigger. The PE range as a trigger. I wouldn't suggest that. I would not.
Hey, Steve and Justin. Thank you for the show. I'm a relatively new investor. I opened up an account looking to kind of invest for a longer-term goal, like an investment property or something like that. Based on your show, I know that a large portion of my portfolio should include bonds. And I know everyone likes to call and talk about companies and options and things like that. But I was wondering if you could give me a rundown on what bonds you guys like to buy, what I should look for when buying bonds. I know there are a couple different types of bonds, investment-grade corporate bonds, treasuries, things like that. I was also wondering what a junk bond is, if that's just a name for a bond or if that means that it's junk and shouldn't be invested in. Appreciate the show and appreciate you guys answering my call. Listen for it on the podcast. Thank you.
Okay, that's a lot of answering to do there. First of all, if you're young, we don't recommend bonds. You don't need to be in bonds. It's only when you approach in retirement that you want to take less risk that you start moving toward bonds. And we like you buying the individual bonds, not the bond funds or the bond ETFs. Now, bonds are a whole different animal from stocks, so it's very different. I'll answer the last question there about junk bonds. Okay, investment grade corporate bonds are triple B plus or higher. That's the rating. There's 2 rating agencies. I won't get into that. But you want a higher rating bond, investment grade. Now, triple B plus or better. Now, junk bonds are rated below that. That doesn't mean you can't invest in them. They're perfectly fine to invest in. Just realize they are higher risk. Now, it goes from triple B plus to triple B to double B plus to double B to double B minus and blah, blah, on, all the way down, okay? So the higher rated junk bonds, most of them are fine. These junk bonds just pay a higher yield. And the problem we've had in recent times is their yields are not enough to make up for the risk. So stay away from the junk bonds. But it doesn't mean you never invest in them. It doesn't mean that at all. Junk doesn't mean it will go under. But junk bonds have a higher percentage of going bankrupt and not pay the bonds back than investment grade. But still, you still can invest in them. You just got to be careful. You're listening to InvestTalk, everybody. I'm Steve Peasley. We want to answer your questions. Our listener line number is always ready for you, 888-99-CHART. Beginning our experience, we're here to answer your question.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
888-99-CHART is our number, 888-992-4278.
Hey, Steve and Justin. This is Tyler from Los Angeles. I have a question for you about indexed variable annuities. You kind of talked about this on a previous podcast. But essentially, I'm wondering your thoughts on these indexed variable annuities that have buffer protection. One was kind of came up in a discussion with me and another financial advisor, and they seem like a great deal. Let's say you take an IRA and you put it into indexed variable annuity. The downsides to this are the illiquidity because there's surrender charges for 6 years. But if you don't need this money, say, you're my age, late 20s, early 30s, you don't need this money till retirement anyways. The illiquidity isn't really an issue because you don't plan on touching it anyways, assuming it's not a Roth IRA. And they seem like a great deal, and I wanted to get your thoughts on it. Again, you have these buffers, downsides are illiquidity. You put it in an S&P 500 index fund, let's say, when you're tracking the S&P, and maybe the S&P is still not weighted exactly how you would put together an ideal portfolio, but given the fact that you have this buffer and the fact that also, the majority of money managers don't outperform the S&P index to begin with, it seems like a pretty good deal, but I just wanted to get your thoughts. Okay, thanks. Bye.
Okay, indexes is a good deal. I like indexing. You don't need to hire people like me if you don't want to. But annuities are expensive. You were talking about the buffer. Maybe I need to explain that quickly to everybody what he's talking about. Some of these annuities now, and they're indexing annuities. It's an index annuity, so all it does is buy the index, okay? They buy a mutual fund, an index mutual fund. So you got to pay a fee to the annuity and pay a fee to the mutual fund. And, of course, you can't get out, or you can, but it will cost you a lot of money because they're selling this. Someone's getting commissions, usually 5% of whatever you put in goes to the salesperson. So you got to usually hold on to them for 10 years. But if you're a long-term holder, like he suggested, that doesn't really worry about anything like that. So remember, and there's two kinds of annuities. There's a fixed annuity and a variable annuity. We're talking about a variable annuity investing in an index. The guarantee that they're talking about, the buffer he's talking about, means that they guarantee you that you will never lose money. The value of annuity will never go below your initial investment. And how can they say that? I mean, what happens if the market crashes? They'll still guarantee it. Now, it's not much risk to them, and there's not much danger for you, because there's been no period of 10 years, well, maybe one in the last 100 years, where the stock market ended up being down. So looking forward 10, 20, 30 years, they pretty much know that, and everybody knows that the market's going to go up. It has an upward bias of 8 to 10% a year. So then that guarantee, I wouldn't pay much attention to it. I don't think it has much worth. And if you want an index, why don't you just buy an index, not through an annuity? They don't have to pay a commission to somebody. Remember, you're paying that commission. Well, that means that you put in 100,000. You're not really putting in 100,000. You're putting in 95. But if you bought an index yourself, you're putting up the whole 100,000. So I would do that rather than buying an annuity. Just my suggestion.
This is InvestTalk, made possible by KPP Financial, where they describe their services as independent thinking, shared success. And this philosophy is why KPP Financial can be of great value to investors. KPP principals Steve Peasley and Justin Klein are committed to unbiased guidance. They don't upsell clients into expensive and questionable investments. Instead, Steve and Justin provide honest opinions and proven strategies based on the individual's current portfolio and risk tolerance. Working with KPP Financial, you can be assured of consistent dedication toward the goal of helping you achieve financial freedom. You can get things started with a phone call or a simple message through InvestTalk.com. The InvestTalk radio and podcast continues now. The phone lines are open. Call with your questions. 888-99-CHART.
Hi, Steve and Justin. My name is Todd in Colorado, 6-month listener here. Love the show. I have a question about where to store holdings for stock buying and investing. I have an IRA, but it's maxed for the year. Is it wise or even legal to have several IRA accounts? Or what is the best way to set up accounts to invest from? Anyway, appreciate everything you guys do. Love the show, and I look forward to hearing the answer. Have a good one.
No, don't set up several IRA accounts. Don't do that because, first of all, you're only limited to a certain amount every year, and you can't have other accounts and put money in them because you can't write them off, and there's no reason for that. And the government might think that you're trying to avoid taxes illegally. So don't do that. That is not a way to do it. If you have extra money, you just put it in the market. You open up a regular account, an individual or a joint account, and just invest it. That's the simplest way you can do it. If you want to sit on cash, you can sit on cash and wait for an opportunity you think that the market's going to provide. So, but just don't try to open up a number of IRAs. I'd like to see you have both a Roth and a regular IRA, but most of the time 401k is fine, and then have a Roth IRA because most employers don't offer Roth 401ks even though they could. You can call right now and be part of the program. Let's hear about what your talking point is. 888-99-CHART, 888-992-4278, and you can get through right now.
Trying to understand how to evaluate some of the oil stocks.
Got a question for Steve or Justin? You're the best person to ask it at 888-99-CHART. And now's the best time.
There's one thing every successful small business owner knows. Finding and hiring the right people is very important. So they want to be 100% certain that they have access to the best qualified candidates available. That's where LinkedIn Jobs is essential. LinkedIn Jobs helps find the right people for your team faster and for free. It's easy to create a free job post on LinkedIn Jobs. To spread the word that you are hiring, add your job and the purple #hiring frame to your LinkedIn profile. And with LinkedIn Jobs, simple tools like screening questions make it effortless to focus on candidates with just the right skills and experience, so you can quickly prioritize who you'd like to interview and hire. This is why small businesses rate LinkedIn Jobs #1 for delivering quality hires versus leading competitors. Listen, you want to finish the year strong, and adding the right team member, the right hire, might help you do that. LinkedIn Jobs helps you find the qualified candidates you want to talk with faster. Post your job for free at linkedin.com/invest. That's linkedin.com/invest to post your job for free. Terms and conditions apply.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
Hey, Steve or Justin, this is Vince from Orlando. I've got a question regarding 401 allocation. Previously on an episode, Steve had mentioned to have, when you're under 40, to have 25% for small cap growth or value, 25% for mid cap, 25% for large cap growth, and 25% in international. But my 401k features some retirement funds, like retirement for 2060, 2055, 2050. Just wondering, what do I do with those? Do I invest in those if those are my targeted retirement date? Appreciate the insight. Thanks.
Well, it depends on your philosophy. Now, I would say always lean on the value side, not the growth side. So you're talking about small and mid cap and large cap, especially in this market, lean on the value side. So don't be heavily invested on the growth side of the market. And then when it comes to your target dated funds, you could allocate a little bit to them, but it wouldn't be ideal. It's a good set it and forget it. If you never want to do any work and you don't want to think about it, it's fine. The problem with it is that it is mainly going to be invested in index funds. And obviously we've talked about how those are poorly set up for this inflationary world when you're overweight, really the wrong sectors, technology and healthcare. So I would not put a ton in those target dated funds. I would try to be a little bit more strategic, but also once again, depends on type of work you want to do. But I like what you're talking about, the 25, 25, 25, 25, and splitting that between small, mid, large, and international, but lean on the value side. Thanks for the call.
Okay, let's pivot to an InvestTalk voice bank for a question that came in earlier, 888-99-CHART.
Hey, how you doing, Steve and Justin? This is Will from New Orleans. I'm giving you a call on, it's not really a stock question, it's more like a economic question. I see China is going through it with these, I think it's Evergrande. Evergrande is having I think they're missing a payment or something. I'm not too, familiar of the exact wording, but I did read that they have ghost cities in China. And it just seemed like China is just doing a lot of falsified things, like they're just hiding the real truth and just putting out information. So my question is, I see Bridgewater, the world's largest hedge fund, sold $1 billion worth of Chinese stock. So I'm thinking, what do you think about the Chinese economy and what domino effect will that bring to our economy if Evergrande, collapse? Just give me your thoughts on that. Thank you.
Actually, it's a very good question. Evergrande is a builder, one of the biggest, largest builder in there, and they were building apartments, apartment buildings, selling to the public, and they were selling them before they even built them. And how they got the money? Okay, they got the money through bond sales, and municipal bond sales and stuff. And so it's kind of a domino effect. They can't produce any more money. They ran out of money, and they didn't finish the buildings. Some of them they didn't even start, and the people have already bought the buildings, have mortgages that they're not paying. It's kind of collapsing. I think their economy is really in trouble. I saw a report that the economy is going to grow 4% this year. But you know what? You're right. We don't really know. They can hide a lot. They can't hide everything, but they can hide a lot. One thing it should tell us is that the demand on commodity prices commodities are probably going to go down, because you can't imagine how much pressure China puts on commodity prices and commodity supplies. So that's probably going to ease off a bit. They're still growing, but it's going to ease off, and I think that will help us get control of the inflation here in the United States. And other places of the world. But one of the issues of inflation here in the U.S. that I don't see us controlling is wage inflation. I don't see that, with the jobs we have and the jobs available and workers, not going back to work because they don't feel like it and quitting their jobs, a high quit rate, and demanding better benefits. And it just seems like wage inflation is going to continue. But that's a very good question. I think China's economy is in a lot worse shape than that we know. And we probably will never know. They've been hiding it for years.
This is InvestTalk, made possible by KPP Financial, where principals and InvestTalk hosts Steve Peasley and Justin Klein are independent financial advisors. For clients, they are fiduciaries. Steve and Justin have a duty and a commitment to always place the interests of their clients ahead of the firm. This is different from the way many other organizations operate. And one way you can realize the benefit of an association with KPP Financial is to know that KPP practices parallel investing. This means that the personal investment accounts of KPP principals participate with client investments at equal prices and percentages. It's an important difference. You can learn more anytime at investtalk.com or reach out to Steve Peasley and Justin Klein by emailing or calling their Irvine, California office. The InvestTalk radio and podcast continues now. The phone lines are open. Call with questions, 888-99-CHART.
Hi, folks. This is Ben from Connecticut. I'm just calling about some of the fundamental analysis that you guys do, what type of metrics you look for, without giving away the secret sauce. Basically, I'm curious on what numbers you look for in the ratio of EV to EBITDA, and then price sales, and then price to book. So if you guys could provide a kind of range that you use to determine the value in that way, it would be helpful for my own fundamental analysis. Thank you. Love the show. Been listening to it for years, and I await a response. Thanks a bunch.
Okay, I wish it was as simple as just to give you the numbers and say this is what you look for. But you have to break it down by sectors and types of industries. Because, you can't compare a tech growth stock with an industrial stock. The numbers are very different. The PE ratios, the earnings, the EBITDA, everything is very different. So it's not that simple, okay? You do know that the overall S&P 500 PE ratio is between 15 and 16. So in general, that's, if you're a value investor, you want to pay less than that. But if you're a growth investor, you're going to pay more. See, and then it winds down to the individual stock positions, from sector analysis to the economic projections to sector analysis to the individual stocks and how they perform against each other. It is just not as simple. I can't just say, okay, I'm looking for, I can say stuff like, we look for rising profit margins, rising, not falling. Stay away from falling. We like to have value plus growth in the stocks we buy, generally speaking. And it depends on what kind of investor you are. If you're an income investor, we love high dividends. And therefore those metrics are very different of that company than one who doesn't pay a dividend. So that's about as best as I can do as far as answering this question. It's tough. It's very difficult.
Do you have questions about FDIC security, mortgages, money market funds, losses to your retirement plans? Give us a call today, 888-99-CHART.
Hey guys, love the show. This is Corey in North Carolina. I had a question about my IRA. I have a traditional IRA, and I started out with about $2,000 in it since been listening to the podcast, and it's grown just based on some penny stocks I've invested in to a little over $12,000 now in just a couple months. I'm 32 years old, and I'm wondering if I should convert it to a Roth IRA just based on, paying the taxes up front now, and if I continue to grow it more and more using that Roth advantage of, getting the tax breaks, 59.5 or however old it is you have to be to draw from the IRA. Look forward to hearing the answer, and keep up the good work. Thanks, guys.
I wish there was a simple answer to that, but there isn't. So I was wondering if you have from your work a 401k, and is that a Roth 401k or a regular 401k? If you have a regular 401k and you have a regular IRA, then I'd probably be more prone to convert it. But you realize you can open up a Roth and just convert part of it, because whatever you convert is going to be added to your incomes for that year, and you're going to have to pay income tax. So whatever you convert from your regular IRA to the Roth, remember, you convert $2,000, well, that's $2,000 more in your income tax. So what tax bracket are you in? So if you're in a very low tax bracket, then it might be wise to convert it, because you'd be paying low taxes. But if you convert the whole thing, would that push you into a higher tax bracket? And do you want to do that? That's why I said it's not a simple answer as yeah or no. Do it. It's just not that simple. But these are the things you got to consider. So if you want to talk about it, or you can talk to your accountant. That might be the smart place to talk to initially, to see what the burden of tax would be if you convert it. Good question. Thanks for the call. I appreciate it.
Let's go to Dave in Ohio. Who wants to talk about dividends.
Hi, Justin. Thanks for taking my call.
Of course.
And I listen every night.
Appreciate it.
My question is about dividend investing.
Okay.
I have about $1.2 million invested, and it's generating about a little over $3,300 a month.
Mm-hmm.
I was wondering is that on the low side? I mean, should I be making a little more money on that? I mean, just your thoughts.
Well, I mean, you're talking roughly a 3.5% yield, somewhere in that range, which I think that's sustainable. It seems like. Obviously, depends on the companies, and that's really what I'd really like to do is dig into the companies that you're owning. So if you want to set up a portfolio review, I think that would be helpful, because remember, dividend investing is not about the dividend; it's about the company, because the dividend can go away. Any company can eliminate their dividend at any time, and if their business model becomes impaired for whatever reason, that's the first thing they're going to do. If they're trying to repair their balance sheet, they're trying to reinvest in their business, well, paying out to their shareholders is not going to be a first priority. The first priority is staying in business and growing their business. And so, it's 3.5. I'm glad you didn't say 7, because that would mean that, hey, you're owning way too many companies that have huge dividends, which means they're very high risk. And sometimes that high risk is warranted, and it's smart because they have a good plan and et cetera, and they're going to dig themselves out of whatever they're in, and that's a nice yield. But for the vast majority of companies, it's a modest dividend, 2%, 3%, 4% is probably where you want to be, and you want to focus on those companies that have consistent profitability, cash flow, and their payout ratio is relatively low. Their cash dividend payout ratio, meaning the percentage of their cash flow that they're paying out into a dividend, is relatively low as well, and that's important. So I'd really encourage you, reach out to me, go to investtalk.com, set up a portfolio review. I'll look at all your positions and give you a sense of, are you invested in too high risk names? How much risk are you taking overall? Should you be shifting to different sectors, different parts of the market, small cap, mid cap, et cetera? So I really encourage you, Dave, to reach out to us, and we can set something up via GoTo meeting or a phone call. So thanks for the call, Dave.
888-99-CHART, everybody. Give me a call. Love to talk to you. We're live, and we're going to go to Mark in Morgan Hill. How you doing, Mark? Morgan Hill, by the way, is in California, up the coast a bit from me and down from San Jose, down from Silicon Valley. How you doing, Mark?
I'm doing well. Thanks for taking my call.
Thank you.
I had a question about closed-ended funds. I discovered them about almost a year ago, and I went from investing a little bit to quite a bit, over 200,000 now I'm in them, including munis. They're doing really, really well. They're not talked about very much in investment circles, and it's hard to get information. So I wanted to ask you your thoughts on them. I realize there's risk involved, but so far so good for me. I just wanted to know your thoughts.
Sure. A closed-end fund is neither good nor bad. It's a different type of investment. Okay, everybody knows what a mutual fund is. Everybody knows what ETFs are. But closed-end funds have been around a lot longer than ETFs, exchange-traded funds. What's the difference is between a mutual fund, an ETF, and a closed-end fund. The closed-end fund has a finite number of shares. It can do anything that a mutual fund or ETF can do. Follow an index. It can buy and sell stocks. It can be a bond closed-end fund. But being that it has a finite number of shares, like a company, like a stock company, it can sell at higher than the net asset value of the fund's holdings. So, an open-end fund, which is a mutual fund or an ETF, means it always sells at what is the value of the holdings it has. A closed-end fund can sell at a discount to the value or a premium to the value. So you can buy a closed-end fund and you can pay more than what it's really worth. The holdings are worth less than what you have. Or you can buy at a discount and the holdings can be more. So don't think that it's really that different of an investment than all the others, other than it can sell at a discount or a premium. Of course, you would like to buy it at a discount because you're getting the stuff that it's holding cheaper than the market value is. But there's nothing wrong with having them. There's no magic there. It's just that if you buy a good closed-end fund, you get a good managed fund. There you go. You get the assets that's in the fund. Okay. So they're fine, Mark. There's nothing wrong with them at all. Nothing wrong with them. But you do want to know if you're buying at is it trading now, as they've done very well, as you suggested? Is it at a premium to what the holdings are? And maybe you want to, sell some because it's at a premium. Okay? Now, if you have a question about a stock or an IRA, college savings plan, well, maybe buying a house, mortgages, reverse mortgages, we're here for you. 888-99-CHART, 888-992-4278.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
Hi, Steve and Justin. This is Kevin from La Crescenta, California. I know that you guys don't necessarily follow any particular research or buy any research or make your trades based on any outside research, but I'm wondering if there's any investors, besides Warren Buffett, where you kind of just follow their moves and don't make the trades based on it, but it just kind of piques your interest. If there are any investors you kind of are interested in what they're doing. Just a question I've been wondering. I'll be listening for your answer on the show. Thanks.
Sure. That's a great point there, that you never want to make a decision based on one thing. Warren Buffett buys it, so I'm going to buy it. It's a terrible way to make a decision. The risk tolerance level for Warren might be different than yours, and his overall portfolio construction might be different than yours. You maybe disagree for his reasons why he's buying that particular company. And Warren's been wrong. Throughout his history, he's been wrong plenty of times, just like we all are. We're all wrong. So, you're not going to guarantee yourself a profit by investing away one particular investor invest, because we all make mistakes. So what you want to do, though, is maybe, like you said, spark your interest in a particular name, do a little more background research, look for other opinions, look for the risks, as well as understanding the upside, and then making a fully informed decision. Then you can go and make the trade. Are there others that would like? Yes, Seth Klarman. He's a big hedge fund guy. On the bond side, I do like Jeffrey Gundlach. I think he's very astute, and he understands kind of the macro dynamics. Ray Dalio is also very good. Bridgewater's kind of quad matrix is a good way to understand over and underweight particular sectors. So those are helpful. But for example, Ray Dalio, I don't buy into this China's going to surpass us type of thing the way that he speaks about. So it's a good example is where I don't agree with him, even though I respect a lot of his thinking. So make sure you take anybody's opinion, including my own, with a grain of salt.
Hey, how's it going, Steve and Justin? I have a quick question in relation to options trading. Appreciate all the insight and knowledge. I've kind of taken that and been able to implement it into a trading strategy that I've done quite well with. So my question is kind of related to tax implication associated with it. I know these are all short-term gains. I just wanted to know if there was any avenue to offset this, or when you're dealing with short options, you're just kind of stuck with paying this high tax rate. So I'm looking forward to hearing the answer on your show, and thank you again.
Yeah, you're right. Option trading, that's short-term capital gains, and the only real way you can deal with that is end-of-year tax loss selling. In December, look at your positions. Maybe there are names you can switch out, positions you can switch out. Maybe you're long Exxon and you sell Exxon, at a loss, and you buy Chevron, for example, something very similar, and you can take that loss but still keep access to that particular sector, for example, or type of company. Same with options, right? You're probably going to be down on some options. Take some losses before year end, rotate those into some similar type of names. So tax loss selling is really all you're going to be able to do to mitigate those gains. Yeah, that's the point of options. It's speculation, and speculation is not taxed at long-term capital gains. The point of long-term capital gains is to get you to hold for over a year, and most of the time, in the option market, you're not doing that. Thanks for the call.
Hey guys, this is Dan from Seattle. You guys manage my portfolio. I just wanted to say thanks. You're doing a great job with it. But I manage my niece and nephew's Roth IRAs, and I just had a quick question. I have them in the 3-fund portfolio with 3 ETFs, SCHG, SCHV, and SCHA, which is large cap growth, large cap value, and small cap stock or ETFs, all through Schwab. And what we do is every month we go in and we buy whichever one is down the lowest. So we've been buying lots of value over the last 2 years, and now we're buying lots of growth. And I know you say growth will probably underperform, but with them having such long time horizons of those 20 years old, 18 and 20, is that a good strategy just to keep buying whichever one's dipping the most and not letting them get too unbalanced? But I just wanted to see what you thought of that 3-fund portfolio and that strategy. Thank you.
Frankly, there's nothing wrong with it if it's a long-term outlook, because there's times when value outperforms, there's times when growth outperforms, and we've been dealing with growth outperforming for a number of years, and we feel, Justin and I feel that values turn. But that doesn't mean growth doesn't work. It just means that value should perform better for a while. How long? We don't know. I mean, no one really knows these things, but I think a good spread that you have, and ETFs are spread out broadly into the sectors they're in, I see nothing wrong with you holding on to that. It will be fine.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461. Steve Peasley is president, and Justin Klein is chief executive officer of Klein, Pavlis, and Peasley Financial. Thank you for listening, and your comments and questions are welcome on our 24-hour listener line at 888-99-CHART.